Hello, this is Char Karnes, Chief Market Strategist at ETFGuide.com. Thanks for joining me today as I take you through our recent gold trade and how we were able to get ahead of the recent rally, suggesting longs back in December when most everyone else was bearish. So the metals markets, they're driven as much by sentiment as they are by rationality. The public is the best example of this, as they typically allow their emotions to make trading decisions for them more than they do rational reason. So here's a case in point. When was the public most bullish the metals? It was back in 2011, near the top of gold, when it was hitting $1,800. And conversely, when were they most bearish? It was recently, after gold fell 30% from that high of 1,800 down to 1,200. So what I'm showing here on the chart right now is the recent one-year history of gold. And you can see that in June you had a very steep decline and kind of a hammer bottom here, and a rally up back to 1,400. Then you had a slow and steady decline again back to December. And what was going on here emotionally is that long-term bulls were starting to turn bearish. Some of the more famous, outspoken celebrities, I won't name names, but they're typically on CNBC and popular on a lot of those shows. They started to say that they're not going to touch gold with a 10-foot pole right around these prices of 1,200. And when that occurred, it kind of it piques your interest, because when long-time bulls start capitulating like that and throwing in the towel, it often marks major turning points in the metals. But there's more to it than that, and let me pull up this chart. So this is a chart that we included in our December 20th ETF Profit Strategy newsletter for our subscribers that shows the long-term history of gold as measured by its ETF GLD. And you'll see on the chart the red and the blue. Now the red I have labeled along with the blue in the upper left-hand corner as the smart money, and in parentheses it's called the commercial traders. And the blue is considered the dumb money, and in parentheses it's the speculators. Now this isn't stuff we made up. This is actually data provided by the Futures Commission that segregates whether the futures traders are commercial traders or speculators. And those are really the only two options there are. So for every trade, you're either a speculator or a commercial trader, or it's speculators trading with each other or commercial traders trading with each other. But ultimately, you can get out of this data, you can figure out whether the commercial traders are net long or the speculators are net long. And that's what I've labeled on the chart. So let me take you through it real quick. And we'll start just by looking at the red, which is the commercial traders, and which is typically labeled the smart money, and you'll see why here in a second. So back in 2005, the commercial traders were bullish. Back in 2006, they were bullish. Back in 2009, they were bullish. And then again, in 2013, at the June and again at the December bottom, they were the most bullish they have ever been in the last, however far back the data I had went, which is, through early 2000s. So this is real money, and these are real futures contracts measuring that these commercial traders, which typically are bullish at the bottoms, as they were back in 05, 06, and 08, they were again as bullish as they have ever been. And then on the flip side, the speculators, which you can see typically are the most bullish at peaks in the market, and these would include more, the public as speculators, the small money speculators. Notice that they were extremely bullish right at the most bullish they've ever been at the peak in 2009, the second most bullish they've ever been at the peak in 2010, and then the third most bullish they've ever been at the ultimate high around 1,800 in 2011. So that's why we call the speculators dumb money. So combining this sentiment data and real money data with the technicals on the short-term chart that I have here, which is a double bottom from June to December, and then you get a little breakout here, and you start to get very bullish the metals, which we were. So in that newsletter, we suggested to our subscribers buying GLD call options, specifically the $112 strike price GLD call options for around $640. Within 2 months, we were able to close those call options for a 66% gain. We also, on Christmas Day, sent out an alert via our weekly pick to buy GDX, which is the gold miners ETF, which is the ETF that tracks the mining companies that mine gold, which typically follows the prices of gold and silver. We suggested buying that around $21, and we moved our stops up as high as $24, which we exited the position recently, capturing over a 10% gain there. We also dabbled in some of the individual miners, as I called them out in a future ETF profit strategy newsletter, profiting a few percent on that as well. So now you can see kind of how we did the recent gold trade. I think right now gold, it's obviously it's had a big pullback. It's testing its 200-day moving average. We'll probably get a bounce here in gold and silver. I don't expect it to make a new high above 1400. In fact, I think over the long run, you're probably going to see gold and silver make a new low below this double bottom here, or at least test for a triple bottom at 1200 or below it. Thanks for joining me today, and please check out some of our other videos at etfguide.com, including one I did on Apple using technical analysis that helped us get ahead of its 8% earnings decline and why we were bearish Apple before they announced that huge earnings miss. We also are on Twitter. You can find us at etfguide.com. We do a monthly newsletter, a weekly ETF pick, and I do a twice weekly technical forecast. Thanks for joining me.